Welcome to the Real Estate Masters Podcast, where we interview the top names in the real estate game. If you want to grow your real estate business, see more podcasts, or get free resources, go to www.remcommunity.com. The only podcast that allows you to directly connect with the guests and many of the highest level names in the real estate game.
You are in for a treat with our next guest. Do me a favor, subscribe to the podcast, leave us a review, and don't forget to go to remcommunity.com to connect with some of the highest level real estate professionals in the United States through our community and through our high level masterminds. Let's go.
Welcome to today's show, you guys. I have an exciting guest with us today, Zain Jaffer. He has an impressive resume. He recently, a couple years ago, sold his startup Vungle to Blackstone for $780 million. Now he owns Bluefield Capital, or is part of Bluefield Capital, investing in large commercial projects. And I'm excited to kind of jump in and see, the entrepreneurial mindset. It sounds like he's done some big things and is getting ready to do some bigger things, or still doing big things. And looking forward to the conversation. So Zain, welcome to today's show.
Thanks for having me on.
Absolutely. Absolutely. So let's start there. Resume. So tell us about Vungle. Tell us about the whole process. People talk about exits. They talk about, starting up and exiting at some point. You had a really big exit. Most people don't even, aren't able to exit just because they don't have a scalable business that they can sell. So tell us how you started it and kind of tell us about that whole process.
It's easy to think of everything as a moment in time, like an overnight success. It took years and years in the making. I think it started when I was a teenager, grew up in the UK, rough neighborhood. And so I had to hustle, and I learned how to use computers to the point where I was coding and designing. And so that's where the itch started. And I'd say I probably did 4 startups, all of them failing, everyone begging me to get a job and to follow a traditional path. Of course, I was forced to go to university, and I don't regret that. It was a good decision, but I just couldn't shake it off. And how lucky that when I graduated, it was the credit crunch, and no one could get a job. All these banks went under, and yes, I could go back to doing what I love, which is startups. And like a decade later, the exit happened after that. So a lot of hard work, really, and quite a bit of luck too.
Yeah, there's always luck to it, but people look at something like that and they're like, man, that guy's got it made. I'm sure it was, you started it and all of a sudden it took off and just, went to the moon. But, I've got stories like that where I've started different things, some have stuck, some have completely failed. But what it comes down to is being resilient and figuring out what you do best and what you can, what you can make work. So how did that feel? I mean, doing that exit, did it feel as good as you thought it would be, or what most people would think? The feeling of selling something that substantial to a company like Blackstone?
Yes, obviously I'm grateful for the situation, but when you talk about to the moon, yes, you're going to the moon. Along the way, you've crashed into some asteroids. You've run out of fuel almost. You're having a crash landing in some ways. You walk out with your limbs intact, but you're horrified and scarred. I mean, it was brutal running a company through all the ups and downs, but it was a rocket ship for sure. I'm grateful. I think this is sort of segues into real estate. Being a startup founder, your net worth is entirely illiquid. It's volatile. And you see all these other people in real estate making money buying things, and these buildings, people are paying rent, they're getting cash flow, they're doing some smart tax advantaged things, and they're also taking loans out. And there you are as a startup founder, you can't even take a salary for many years. And so I was like, I want a piece of that. I want to move into real estate and have that easy lifestyle where cash flow just comes through the door. It's not been the way I thought it would be, but that's sort of the way I wanted to do something different for a little bit. But yeah, the itch is still there to do another company. And I'm curing that itch partly right now by investing in startups as well. But the itch will always be there, and I probably will do another company eventually.
Yep. Yeah. Well, tell me about Bluefield. What you kind of mentioned what you concentrate on. It's different commercial real estate projects. You said 10 million plus. Tell us what you're looking for, and kind of how you analyze deals and how you're making that side of it work.
Yeah, so I joined Bluefield because I wanted to learn about real estate, and I tried to learn by doing it myself initially. I had my family office, which basically means I got a bunch of money and I'm going to start buying things and learning how real estate works. And I also invested in a lot of funds. I invested in Bridge, RXR, Blackstone. Bluefield was one of the funds I invested in. And it was when I was doing my own stuff, working really hard, trying to sweat the assets and everything. I got the K1s from my funds I invested in. And I was like, what? How are these guys outperforming me? I'm not having to pay a management fee to anyone. I'm not paying acquisition fees every time an asset's bought. I'm not giving a percentage of the profits up to a fund. How are these guys generating more cash flow than I am? And that got me talking to them. And I was like, okay, I can't compete. Bluefield, I think it was founded in 2013 or 2014, and it's delivered a net IRR to investors of about 33% realized. And unrealized is probably going to be same or higher. And I look at what they're doing, and they're buying multifamily buildings throughout the US, often in secondary, tertiary markets you might not even, be familiar with. The price ranges are like $10 to $50 million acquisitions, so too small for private equity, but a little bit too big for your mom and pop folks who are breaking into real estate. And also not just multifamily, but hospitality, industrial, senior care. They're doing some fun stuff too, like ground up construction and some student housing and single family rentals. And then we're also looking at things too, like cloud kitchens. So decided to join them because they've got a great platform, and it's a better place to learn. And I can now see why it's hard to compete with a more established fund versus going it alone yourself. Unless you focus on one market and that's all you do and it's the market you live in, it's hard to do things remotely. Like I live in California, and I was buying real estate throughout the US and actively buying it in Texas, especially. And it's hard, you've got to fly all the way to Texas regularly. And if you don't do that, your assets are not going to be managed well. Whereas when you have a firm with infrastructure, it's a little bit different.
Yeah. Where in California do you live?
I live in San Francisco, where not many people seem to be wanting to live here anymore. They're all flooding pastures like Utah and Miami and Texas and other places.
Yeah, I'm in San Diego. I'm kind of seeing the same thing. A lot of people moving to either save taxes or get away from some of the political stuff going on here in California. Oh, yeah. So yeah, I get it. Well, cool. So tell us 33% IRR. That's pretty impressive. Why do you think they're able to get that high of a return when most most funds are typically offering anywhere from 10 to 12% on the low end to usually 18 to 20% is the highest you hear from most funds that are paying out to their investors?
Well, Bluefield had the same. I mean, when I invested in the projects, there was a lot of conservatism and a lot of expectations that look, historically, we've done well. We think the market's at kind of a bubbly stage right now. And, we're underwriting deals for the mid-teens IRR. And they have done that in every deal. And I appreciate that conservatism versus other people who just want to take your money and deploy it, right? Because the incentives are there for a capital allocator to do that. So I think it's being conservative. I think really good fundamentals, trying to do a lot of off-market deals, underwriting very conservatively, smart leverage. I think those are probably the reasons, and a lot of luck, being in the right time at the right place. A lot of the places Bluefield's invested in have turned out to be really hot markets. A lot of the partners are based in Utah, Salt Lake City, which has been a very hot market where they disposed a lot of assets to their regret, by the way, you talk about a 33% IRR, but if we'd held on, we would have maintained those IRRs, if not exceeded them. And it's ultimately about, the multiple on invested capital. I mean, here's the problem when you're trying to understand investment, right? What do? Do you focus on the cap rate of the asset? Do you focus on the cash on cash return? Do you focus on the IRR you're going to generate? Do you focus on the multiple invested capital? I mean, all these things are things to consider, but all things equal, I love the firm because they're very, very conservative. It hurts us in an environment like this because we're having a hard time buying assets. It's kind of crazy out there right now. We've been buying, but there's a lot more we wish we wanted to buy. We bought a third of what we wanted to buy. Two out of every 3 deals that we enter into, we're not able to close on. not close them. We're not even selected as a bidder, and we just don't understand how people are paying what they're paying.
Yeah, it's a crazy market right now. Well, let's go back to your entrepreneurial journey. You said it was about 10 years from the time you started some of your businesses to the time you exited a couple of years ago. Some of the biggest lessons that people can learn aren't just successes, but actually failures, things that maybe you did that looking back, you either wouldn't have done or would have done differently. What are some things there you can share with our listeners on what you would have done differently going back 10 years ago?
I'm glad I jumped into it when I did, and I didn't realize how exhausting it would be, how much I would sacrifice. I wish I had had a better work-life balance. Yes, you have to hustle like crazy as a founder, but staring in front of your computer and just coding away or making calls, at some point there's diminishing returns, and you need to rest, you need to sleep. And so I think the impact on my health was destructive, and it's taken years and years to recover from that. So I kind of blew my best years. My 20s were spent just working nonstop trying to build companies, and now in my 30s trying to live like I'm in my 20s. And you just can't lift what you used to lift when you go to the gym. You just don't. You're getting older. So I think the timing is everything, and I took a lot of risk. I funded the business, literally, my co-founder and I, with our credit cards. Very dangerous. That was reckless. We got lucky. We look, I felt like I went to Vegas and I betted on the roulette wheel, and I got very lucky. Doesn't mean it would work for everyone. Now that I'm on the venture capital side, now that I'm investing in real estate, but also investing in startups. Yeah, it's true. 9 out of 10 companies will fail, but that one that succeeds, it's a home run. It not only pays for the ones you lost out on, it multiplies that. So yeah, there's a lot of luck involved. I think you need to pick the right industry, not just the right industry you're passionate about, but a massive growing industry. When an industry is growing very quickly, like the top 5 companies will all be worth, will all be unicorns almost, which was our case. We weren't the largest in our industry. We were just like the 3rd or 4th largest player. And I don't include Google or Facebook. I just mean other startups, right? Outperformed us too. And yet, some of my competitors are now $10 billion, $40 billion companies. That's what happens when you focus on a big market. The market's very forgiving. I say that, sometimes it feels like no matter how many mistakes we make, there's just so much demand for the product, so much demand for what we're doing. I feel like an incompetent monkey could run the company sometimes, I used to say that to people. It's like, it's on us if we screw it up. So yeah, that's some lessons I'd say, to share. You got to pick a big market though, and ideally a big problem worth solving.
Yeah, the work-life balance is a big thing with a lot of business owners. I work with a lot. We have some pretty high-end clients, and I just see the work-life balance thing being a huge issue. I had it for the first probably 10 or 12 years, just working late nights, getting up really early. I mean, sometimes I'd get up at 2 a.m. and start working just because my mind was going, and I felt like I needed to solve problems, as quickly as possible. And I've changed that quite a bit. Sometimes I start work at 7. Today I started at 7, which was early. Typically I start at 8 and end at 5. I'm at home every day at pretty much 5 o'clock and try and shut it off for the rest of the night. Sometimes I'll check some emails here and there, but it's much better than the 8 p.m. to 10 p.m. times that I would shut off. So that's a good lesson. So looking back at the sale, is it something you strive to do? Did you know you were going to sell at some point, or did the opportunity just kind of peek its head out and you're like, man, this is just a good opportunity to unload and be rewarded for the many years of hard work?
I had investors that had a time horizon and wanted an exit, and maybe their other investments didn't do very well. So we would multiply their returns and allow them to raise another fund. It's very hard, when you have a company and you have an exit offer, you have to pretend you're cashing the check, you're giving it to all the employees, and all those employees are going to go and buy. Some of them might buy their dream home. Some of them in San Francisco, for God's sakes, can only put a deposit down on a home, right? But you've got to imagine giving it to them. And then you've got to imagine saying, you know what, actually, I want it back. I want it back because I want to keep riding with this. And when you have a lot of shareholders, I had hundreds of shareholders, you have this fiduciary duty and you have to just basically be quite logical. And of course, what are you going to do when you get advice from everyone? Oh, you should take this, you can always do it again. And so it was the right choice, the right thing. In hindsight, I wish I didn't, because the business probably would have been worth 10 billion by now. And I don't just say that, it probably would have been, given how multiples have expanded and, the industry keeps growing. I was in the app industry, mobile apps. So being in the industry at the right time for mobile apps, it's like, the internet all over again, huge companies have been born out of the way we use our phones. But the itch is still there. I think what stops me is what you said. Like there's been periods where I've decided to just try to build a prototype for fun. And you're like, okay, I'm working like all day and I'm forgetting to eat. I mean, this is not healthy. And I feel kind of brain foggy now and I can't sleep. And I call it being wired and tired. When you said you wake up at 2 a.m. in the morning, right? That's what happens. You're wired and tired and it's not healthy for you. I haven't figured out how to run a company with balance. I want to spend time with my kids, my family. But deep inside, I really want to go back and do another company. But I think I still need a bit more time. And I'm doing things in real estate now and I want to see those come to fruition and build, the dream, right? Like cash flow keeps coming in at a significant level. I kind of want that to be there, and then maybe use some of those cash flows to reinvest into, my own company. Maybe we'll see.
Yeah, I built lots of businesses, and I think being on the passive side of it, which you are at this point, is the best place to be. You can invest in the business. You might be able to put your 2 cents in and maybe advise and kind of, that kind of thing. But when it comes down to it, someone else is doing the hard work.
Exactly. And that was a painful lesson too, where even building my own real estate portfolio, I realized investing in other people's projects might be a better way to go. Pay the fees, pay the carry. It's a good situation because you're going to make more ultimately. And these people are probably going to work harder and have been doing it longer than you have. And the other thing is, if you can figure out the lifestyle hack, which is, it doesn't matter how much wealth you have. Okay. Even if you're just starting out and you want to live your dreams, live below your means. And make sure that you're always generating more money than you're spending. And eventually what you want to do is you want to reinvest that income into new projects that generate more income. Compounding is one of the most crazy, unfair tools that's ever existed. The rich certainly get richer, right? Because of this power of compounding. And there's nothing like compounding I've ever seen outside of real estate. And, you can roll your gains with 1031 exchanges and you can do all this funky stuff. But people that stay in real estate long-term, those cash flows multiply. And when you reinvest those cash flows, if you can just live on a fraction of your interest income and reinvest the rest, you've hacked life. You really have. But it requires modesty and it requires living below your means, Of course, living below your means changes every year. But that's the difference between an investor and someone who just wants to be rich and spend money, because a fool and his money are soon,
Yeah, no, I like that. So tell me about the money raising part of it. So obviously to sell a company for that amount, you had to raise some money. When did you raise that money? So you sold in 2019. When did you raise that money? And tell us about the process. And somebody who's looking to raise money for whether it's real estate or an app or whatever it is, what are some lessons that you learned there?
We raised $25 million in venture capital over numerous rounds. And I think this applies to real estate and to startups. Getting those first checks, getting that vote of confidence that someone believes in you, gives you social proof that you can then leverage to go bring in more investors. Real estate, especially, building a track record with successful returns. And again, same like startups, sometimes you have to sell early, even though you don't want to. Selling your real estate assets early to book a return gives you that incredible track record. Every real estate GP tells you later, I wish I never sold. But Austin, if you hadn't sold, would you have had the track record? Would you have garnered the trust of your investors? Right? Those investors will keep investing with you for the rest of your life and they won't scrutinize deals as much anymore. It's usually, I trust you, you know what you're doing. So that's the parallels to real estate. On the startup side, obviously raising money for a company is extremely different than raising money for real estate. And by God, you cannot, as an investor, look at things the same way. When you're investing in startups, it's about believing in the founder. Trust me, you do not want to believe in the seller who's selling your real estate deal to you, or the agent, right? Big mistake. So you can do that with a founder. You're believing in their vision of how they want to see the world. You're not really focusing on financial forecasts as much. And again, real estate, all about the financial forecast and doing extreme underwriting, So that's probably lessons as an investor, lessons as a founder. I mean, you just have to try. And sometimes I find when people are saying no to you, that means you're onto something unique. When people say this will never work and you push them, why won't this work? They can't answer that question. They're like, well, it doesn't sound, this doesn't make sense. Like, okay, this is good. Because if the investors aren't getting it, maybe competitors aren't getting it either. If I'm getting it and my customers are getting it, I'm onto something unique. Now I'm doing something that every investor wants, but doesn't have the guts to invest in. Category making companies. If you want an exit that's going to return my investors, 200x returns, right? Which is great for someone investing in startups. You've got to invest in something that's going to be a category maker. If you want a 2 or 3x return, go put your money in real estate. Don't put it in a startup. And there's plenty of startups that can generate a 2, 3, 5x return. When you're starting a company and people say no, actually you might be one of those rare companies that might be onto 100x opportunity. If everyone's saying yes, be worried. I always find, think about me. I've sold my company. I'm itching to do another company, right? How many ideas have I come up with? And within a few months, I'm being pitched that idea 10 times by other founders. And I'm like, oh, wow. Execution is everything. And if you think of an idea and it sounds logical and intuitive and everyone's saying it's amazing and you're waiting for that validation, chances are there's lots of other people working on it already. So when you discover something that's a little bit weird, like cryptocurrency, people that discovered how that works, right? Or anything that's sort of a breakthrough. I mean, even Airbnb was very weird when it started.
Yeah.
All these great companies are. That's when you're onto something that's category making and you can generate massive returns.
Yeah, it's that blue ocean strategy. Find something that other people aren't doing and find a way that other people are doing things and just do it a different way. Just like Uber, taxis. Let's go on an app and have other people provide the cars and we'll be the third party company. And just like Airbnb, like you said. So I've got a couple companies like that I started that are taking off pretty substantially because no one else is really doing what we're doing. So, well, good stuff. What else would you like to share with our listeners on your journeys through, whether it's your entrepreneurial journey through your 10 years in your previous companies or the new venture with Bluefield?
A lot of this advice sounds so generic because I feel like everyone's saying it, but it's like I don't want to use a religious metaphor, right? But it's like a Bible or a Quran or a Torah or whatever. It's like the rule book. These things are age-old lessons because they've been passed down from entrepreneurs to entrepreneurs. Do something you're passionate about. Focus on a very big market and don't be over analytical when you're starting out. That's the advice as a founder. As an investor, know why you're investing in a certain asset class. If you're investing for cash flow and you want a 2 or 3x, put it in real estate, right? You're not going to get rich quick, but it's safe. If you want to take a risk and you're able to invest, a lot of people who are investing startups will invest in 1 or 2, which is a big mistake. Go invest in 10 to 20 minimum. Okay. Spread your bets, invest in 10 to 20 minimum, build a portfolio, and each investment has to have the potential of generating 100x return. You've got to look at it that way. Aim for the stars, at least you'll land on the moon. And sometimes you might discover a new star, So that's what I'd suggest. I see too many situations, and I'm a venture capitalist too, right? Invest in a lot of startups. I run a VC fund as well. A lot of people will shoot down an idea because it's risky. Okay, yeah, I get it. There's a maybe a 70% chance this will completely fail and lose my money. But there's a 30% chance it might work out. But if it works out, this company is going to be a 100x company. If they do this, it will return the fund. And I know many venture capitalists who have invested in companies and they've returned their fund 10, 20x. And each company has to be potentially a category making company. So if you're going to go invest in startups, try to copy that mindset. Don't invest in things because it's got good growth on revenue and etc. I made that mistake early on, and you want some safe companies too, but why are you investing in startups, man? It's not for a 3x return. you know?
So when you say invest in 10 companies, that's basically because you know seven, you said about a 30%, 3 out of 10 will probably do well. So you're saying plan on about
Well, no,
seven.
I was giving an example of how I might evaluate the risk of one particular company, but on average, 9 out of 10 will fail, man. Not 7 out of 10. 9 out of 10 will fail.
And you just want that one company to hit big.
Yeah, I mean, if you want to be pedantic about it, here's sort of what I'd say is a rule. Okay, you invest in 10 companies, one hits it really big and should at least be a 10, 20, 30x. Here's the thing, it's like if I tell you it's going to be a 10x, right? Or higher than 10x. What I'm basically saying is I'm going to give you a dice, I'm going to roll it. The worst case outcome is a 10x. The best case outcome could be 1,000x. It's a probability curve. More likely you'll get a 10, 20, 15x or whatever. It's like a wild card, right? That one company. Another 2 or 3 should probably be 2 or 3x, and they'll sort of carry the rest of the fund and subsidize your losses. The rest are complete zombies and they're going to die.
What's the typical investment on those types of deals? When someone invests in those companies, what is usually the minimum? Because some people are thinking, well, I probably don't have the money for investing in 10 companies. How much money does someone have to invest in companies like those for, or have what kind of amount of money do they need to have in order to be considered to be an investor in those companies?
I mean, it's a great question. I think it needs to be money you're willing to lose completely, money you're not willing to touch and see again for 10 years. A sensible amount to me would be 100,000 divided by 10 companies if you're starting out. Of course, the higher the net worth, it just doesn't make sense. And it's hard to get a $10,000 check. Crowdfunding platforms are a really good way to get in. I feel like there's safety there because there's been some validation. There's a fiduciary duty. And if there's any fraud that happens, you're not the only investor in that company. You've got hundreds or tens of others investors involved. If you're smart, you can go to AngelList and try to invest in syndicates. You have to pay a fee or a carry. What I did is I picked a sector I like right now I'm interested in real estate. So I've set up a fund to invest in real estate startups. I've become an expert in that. So now I'm investing in startups that I think I can, understand because I have real estate assets myself. You might be in medical, you might be in real estate, you might be in, marijuana or whatever. Find startups maybe in those areas that you have a better chance at assessing, that you think you can help. Maybe take some advisory shares too. I think that's a good way to get started as well. So you gain some, some sort of sense of how startups work. But yeah, that's probably a good way. I think if you're an accredited investor, which means, you need a certain income threshold, those types of folks, usually I see put in 25K minimums, sometimes 50K, 100K minimums. And those folks will build maybe 10% of their entire net worth will be in startups. I don't really recommend more than 10%, to be frank. Unless it's your full-time job and you're a VC, then maybe you can be 30, 40%. By accident, you might be 99% because you hit an Uber and you can't exit it, but it's got all your net worth. But I think 10% is a smart rule.
Yeah. Okay. Well, we got quite a bit off of real estate, but this fascinated me. And I think a lot of people that I know that are high level real estate investors are looking for that next thing, whether it's investing in other startups or starting in other companies. I think this is pretty fascinating. Just being able to take, money that you've made in real estate and roll it over into companies that could do something way more substantial than, just flipping houses or, buy and hold kind of properties. So let's transition into the commercial real estate and we'll start wrapping up. The thing that I like about real estate in general is just the tax advantages. So when you look at a 33% IRR, is most of that taxable to the investor, or are they able to roll those funds into other properties and potentially not have to pay taxes until down the road?
Yes. So what you're talking about commonly is called a 1031 exchange. And the amount of time someone's like, urgent, we just sold this asset and we want to place it. Do you know a deal we can go in? Well, you and everyone wants to go in there. No, we have deliberately, we haven't had the ability to deploy a lot of that into another asset in the time frame needed because those assets just aren't worth it. We're overpaying. And we have tried, but it's never the guiding priority. We're not willing to overpay simply because we've got access to capital that can be rolled over. It's unfortunate because there are taxes that LPs will have to pay as a result, right? maybe less than half the time we're able to successfully do that. And if you can do that, you're really onto something magical here. Because, quick case study or made up example, right? You're investing $100,000 and let's just say let's be generous and say there's a 10% preferred return, okay? What I love about real estate is that it's so tax efficient. A lot of that cash that you're taking back in the 10% preferred return, because of the way depreciation schedules work, a lot of that can be very tax favorable and, different brackets of income. And then you're also able to take advantage of the fact that when you eventually distribute proceeds to refinance, the investor doesn't have to pay taxes on that. It's seen as a return of capital, or sometimes it's seen as a loan proceeds as well. So you've got all this magic happening where the investor's getting this cash back, and it's like, wait a second, I'm getting cash flow back and I'm not having to pay high taxes on this. I'm getting some refinance money back. Sometimes I'm getting my entire capital back, but I also own shares in the building. This is pretty cool. I just put in, $100,000. I got $100,000 back, but I still have shares in that building. Beautiful, right?
Yep.
It's when the building sells, ouch, that tax situation is going to hurt a lot. So commonly people will do a 1031 exchange. And then if you can successfully roll that into a building and you can go in at twice the basis, now your 10% preferred return is like a 20% preferred return, Another. So tech people, especially when they sell a company, they want to plow their money into an opportunity zone so that they don't have to necessarily pay the taxes now. They can pay the taxes later on and defer it. Again, it's like 1031 exchanges. There's a lot of projects that are just bad projects. And I don't like the fact that you're typically tying up your capital for quite a lengthy period. And it's a lot of work to administer and oversee an opportunity zone investment if you're an investor yourself. I don't mean investing into an opportunity zone. I mean, if you're managing an opportunity zone project, we've looked at some of those and we've done those at Bluefield, and it's there's a bit more administration involved.
Yep. Well, cool. Well, Zain, we're going to start wrapping this up, man. Fascinating story. Going from, you said, a tough neighborhood in the UK to, hitting it big with selling a big company. And I'm sure in some aspects you're living life, but on the other side of it, I'm sure there's something where you're like, man, there's still more to do, right? There's still some other things to accomplish in life, especially since you're so young. So congrats to all your success. If someone wants to reach out to you or get a hold of you, is there anything, do you want to send anybody anywhere to get more information about you or to potentially contact you on anything you've got going on?
Yeah, my family office website is Zain, ZAIN -ventures.com. So Zain hyphen or dash or minus, however we say it, zainventures.com. On Twitter, I'm Zain Jaffer, ZAINJAFFER. Obviously I've got the PropTech VC podcast as well that I run, where I talk about real estate technologies and interview a lot of founders. So that's proptechvc.com.
All right, fantastic. So zain-ventures.com, is that mainly for people who want to potentially look at you investing in their company?
Yeah, that's got my family office. If you want to, if you're a prop tech startup, then it would be bluefieldcap.com. That's I try not to invest in things that can be competitive to my full-time job, where I'm at Bluefield Capital. So that's Zain at bluefieldcap.com. That's probably the best way to reach me if it's anything related to real estate or startups in real estate.
All right, fantastic.
There are a lot of hats.
Yeah. Well, awesome, Zain. Well, I appreciate your time. Love the story, man. And good luck to you. And hopefully the next venture will be just as successful.
Thank you so much.
Thanks for listening. Now go to www.remcommunity.com to connect with today's guest, see our high-level masterminds, and to get free resources. Don't forget to share this with a friend and leave us a 5-star review. We'll see you on the next episode.